and welcome to Two CPAs and the Mic, the podcast where we talk tax, finance, and all things related to business. Whether you're a business owner, working professional, or someone who wants to start a career in accounting, this is the podcast for you. Hosted by CCK Strategies partners Jeff Frable and Sara, we dive into relevant business and tax matters with working professionals to make these topics less intimidating, relatable, and dare we say fun? Let's get down to business.
Welcome to a bonus edition of Two CPAs and the Mic. My name is Jeff Frable. I'm a partner at CCK Strategies, and my wonderful co-host, Sara. What's going on?
Good morning, Jeff. How's it going?
Well, this was a big weekend for us. It was like the Super Bowl. It was like Super Bowl Sunday for CPAs, especially those of us that are involved in tax, because what happened on the 4th of July, Sara?
We had a big, beautiful act signed into law. I didn't say it quite. I forgot an extra B. It's the one big, beautiful bill.
Yes. And when that happens in our industry, it's a big thing. We knew it was coming down. And so what we wanted to do today is get out a bonus episode just to kind of talk through this thing. Now, anybody that's heard our episode on entity selection, Sara, do you remember the disclaimers we did on that one when we started?
We did. Yes.
Well,
we were like, everybody's different. All situations are not the same. So you please talk to a tax advisor.
We are going to have another list of disclaimers here before we get started. And first of all, I don't think this is going to take our normal 45 minutes to an hour episode. No. This is going to be shotgun type of information. The way I'd like for our listeners to think about it is they're sitting in on hearing you and I over a cup of coffee or Mountain Dew and talk about this bill that became law. We are not going to get into the weeds. We are not going to get into all the details, because the truth of the matter is, and Sara, I know you know this.
Yeah.
Just because the act or the bill has been passed does not mean we know exactly how it's going to be enacted, because now it's to the IRS, the Treasury, to write these regs. So there's going to be information that's coming. Thank you to the AICPA and Wolters Kluwer for putting out some information that we'll be using as source information for this. So thank you to them. And really, at the end of the day, we just have kind of run through some of these things ourselves, and we just think it's important to get this information out there. So, we had this huge bill, lots of details, but there's probably several different things that are capturing media attention that we want to talk about. And there are some new things and some changes. So just strap in and listen to the conversation. I think what we're going to do is you're going to kind of hit the individual topics, and then I'm going to hit more of the business topics. But again, just high end. And I know, Sara, you're afraid of having to do some reading on this episode, aren't you?
Yes, because it is still so new, even though we've been watching it over the last few weeks, because we had to watch it as it went through the House. There were changes there, went to the Senate, changes there, then it had to go back to the House. So Jeff and I are going to be doing a lot of reading. We'll try not to make it sound like we're reading, but it will be some.
You know what this reminds me of is in the 90s, I was at a concert, and this was a Christian band that had this monumental release back in the 90s. I'm not going to say who they are, but I was at this concert, and it was a very, very, very small venue, and they literally had the music on the stand to read, to play, and to sing the lyrics, because the music was that new. And that's kind of how I look at this, is we are professional musicians looking at this new song, and we are figuring it out. So let's get started. Now, I think before we get started, though, maybe to help with some language, we're going to say some things over and over again. And if we can maybe describe what those are. First thing that comes out is we've got JCTA, which was the tax law that was passed back in 17 and 18 with Trump's first administration.
The Tax Cuts and Jobs Act. Yep.
Those are the things that are going away or we're going to expire.
Mm-hmm.
You already mentioned the OBBB. That was the name for this bill. Interestingly enough, did you see it? It got stripped. The name got stripped for some reason, which is
but we're still going to call it this.
Yeah,
always and forever. It will be called this.
So we've got current law, and then we've got the new bill. So that's kind of the way we're looking at this. We've got different kinds of implementation dates and stuff like that. And maybe the most important thing to say here, Sarah, besides we're not getting into the weeds, is we are not getting political in any way,
no,
shape, or form.
Yes. We are keeping it. There's so many things in this act. We are keeping it strictly tax related. We're not going to get into all the other hype that
who's
both
getting
left
hurt,
and right
who's getting helped, and where the money and the budget
going
deficit. All that.
We're not doing all of that.
We're helping you understand how this impacts your tax situation, whether you're an individual or an entrepreneurial business owner going forward. So again, let's get into it. We're going to, again, hit this rapid fire. We're not going to get into all the details, but let's go, Sarah.
So we're going to break it down. There were for the individuals, there were some provisions that were extended from that TCJA Act. And then there's some new individual provisions that came out of the OBBB. And then there's some business provisions, and we'll highlight all of those. So let's get started with the extended provisions for individuals. So some of the things that were set to expire were the current tax brackets. So right now the tax brackets go from 10% all the way to 37%. There were some things that were set to expire. And again, expire at the end of this year, 2025. The elimination of personal exemptions, we haven't had those since 2017. They were going to increase some alternative minimum tax, AMT. There were so many things that were going to expire, but now a lot of things are going to be set in place and made permanent. So the first thing that is the tax brackets will stay in place, the 10% all the way to 37%. Those are for sure stay in place. The bracket ranges will be adjusted for inflation as always, but those brackets will not change. And it does personally eliminate the personal exemption. So if you'll remember, what was it, like $1,000? I mean, it's been so long. Was it like $1,000?
It was like $1,000 per person.
Per person that you were claiming on the return. So those are set to go away completely and permanently.
So
there are
what I'm hearing you say is the way things are the way they're going to stay.
Yes.
Because they were going to change.
Yes, so at the end of this year it was going to be.
There's a change means there's no change.
That's right.
Okay.
They made it permanent into law. Yes,
okay.
It is. And thank goodness it's permanent. So we don't even have to worry about anything expiring in the future on those items. Right. Now, the one good thing that did come out of this, that there is for seniors. So if you're a senior between the age of 65 and older, after the year 2024, you do get a personal exemption up to $6,000. It does get phased out depending on your income level, but that is a good thing for seniors. And I think that kind of is one of the things that Trump did promise, which, a little spoiler alert for later, was the elimination of Social Security income from being taxed. And I think this was a good swap for that. So they're giving the seniors this personal exemption deduction. The other thing that was set to expire for at the end of 2025 was the standard deduction. So prior to the TCJA in 2017, the standard deduction was really low, for joint filers, it was like maybe $12,000, $13,000, somewhere around there. And now, we're up in the 30s for married filing joint, $30,000 for a standard deduction. And that is set to be, that's one thing I need to look at, Jeff. Is that permanent? Did they make it permanent or just through the end of the year? Or through a deadline? I think they made that permanent. That's what I'm reading. See, here we are, just reading along.
But the key is again that what
it stays.
It's staying the same.
That's right.
because it's not expiring. So
That's right. And one of the key provisions that if you can itemize, which is, you can itemize anything over a combination of your real estate and state withholdings and your mortgage interest and your charitable contributions, if those are high enough to where you can itemize over that standard deductions. One of the most controversial provisions that came out of that was the cap on the state and local taxes. It's $10,000.
which ends up being really low.
Yes. Most people are just capped at that 10,000, and there's so much excess that is not even deductible. But now they've increased that limit starting in 2025 tax year to $40,000, which is great.
And there's some income limitations there, right?
Yes. There's some income limitations. That threshold for adjusted gross income is $500,000. So it is reduced by 30% if you go over that $500,000 mark. And that's for a taxpayer, so it's $5,000 or $500,000, excuse me. And that is set. It is a timing limit. So it's through tax years 2029. So after that, it'll go back down to the $10,000 cap, unless, we have
somebody
another
does
wave.
something about it. Yeah.
Yes, unless another wave comes through.
But this was a big deal. This was a kind of a sticking point. I'm going to jump in here real quick because one of the things that impacts the business side of it is that when individuals were getting limited by this deduction, in other words, they would pay $100,000 in state tax, and they would only be able to claim a $10,000 deduction. There were a lot of states that implemented a pass-through entity election.
Yes.
So in other words, the entity could pay the tax and get the full deduction. And there was talk about that going away or having more limitations on that. But the pass-through election for entities has not been addressed, which means it doesn't change. So if you are getting capped with an itemized deduction in this area, you still can use the pass-through election. Generally speaking.
And most states have implemented that pass-through election. So while we're not going to get into the weeds for each state, make sure you talk to your tax advisor to see if your state has that pass-through election. All right. And then moving on to the other thing that was set to expire at the end of 2025 was that increase in the child tax credit. It used to be $1,000. I just didn't remember that. That's been so long ago. Low. Yeah, and it was set to go back down to that. It currently is at $2,000. Well, now they have increased that to, or left it at $2,000, but also increased the base to $2,200, which is great. And then they also have changed. There was a piece of that, depending on your income limits. Part of that child tax credit was refundable, and they've changed that and increased that refundable limit to right now it's $1,700 of a refundable credit for 2025. That's per child. And then the other big thing that was set to expire at the end of 2025 was the estate tax basic exclusion, which right now with inflation, it was just under 14 million, 13.99 million in 2025. And it was supposed to go back down to a very, very low limit that was pre-2017. And they have adjusted it to keep that increase of 15 million. That if you die, not to be morbid or anything, but if you die between now and
pass away,
between now and the end of 2026, that exclusion is 15 million per taxpayer. So that is a good thing. So, but one thing to keep an eye out on is that they've only done anything with it through the end of 2026
next year.
So we still have to keep an eye on it.
And our clients have been doing a lot of planning around this because they're trying to manage any potential estate tax. Bottom line is they have an additional year to work on some of these things, gifting ideas or structure ideas.
That's exactly right. All right. Well, that pretty much sums up the highlights of things that were set to expire and that they either extended out or made permanent. So some of the new things that were implemented with this new with this new law that for individuals, the huge thing that was part of Trump's campaign was no taxes on tips. So that's a big thing. So you do still have to claim your income on tips, but you get a deduction for those tips. So you'll report your full tips, and then you can take a deduction on that. But the deduction on the cap is at $25,000. Now, Frable, I'm going to say right here, right now, if you're making $25,000 in tips, you're
doing pretty good.
Yes, you are freaking awesome. So I'm just saying. So $25,000 in tips is pretty good for them to cap, but that is the deduction cap.
So the key here again is that it's not that you never pay tax again on tips. It's that there is a threshold of $25,000, so you will not pay tax on the first $25,000 of tips.
That's exactly right. That is exactly right.
Given certain income thresholds. So,
yes, that's
and
exactly right.
If you're making that much overall, it's okay because you've got money in your pocket. But
that's right. That's right.
In all of these things, and it gets so redundant. There's income thresholds, there's reporting thresholds, and things like. So it's rarely black and white. But
right.
All right,
exactly
25,000 on tips.
Yeah, 25,000 on tips. Now, just to kind of bleed a little bit into the business area, there is a employer credit on Social Security tax on these tips. And it used to only be for the food and beverage industry, and now they've expanded it to include the beauty service industry.
Right.
So that is a good thing to get that employer credit on the Social Security taxes. So if you are in the beauty service industry, please get with your payroll provider, and they can help implement that
Could be
credit
some
for
changes
you.
there.
Mm-hmm. Yep. The other thing that President Trump was pushing for in his campaign this go around was no tax on overtime. So that has gone into law, so there won't be any tax on overtime. But I will say that the deduction is capped at $12,500 per taxpayer. So if you're married filing joint, that's $25,000 total for any overtime. Now, there are, again, just like with the no tax on tips, there is also a adjusted gross income phase out. If your income is over $150,000 for single or $300,000 for married filing joint filers, that deduction will begin to phase out. And then I failed to mention this on the overtime, or on the tips. So both the no tax on tips and no tax on overtime is for tax years 2025 through the end of 2027. 2028. So those deductions will phase out and sunset at the end of 2028.
But the important thing is they're applicable in 2025. And
Yep.
Just like the tips gets limited to 25,000, the overtime is limited to 12,500 per person.
That's right. That is exactly right.
Okay.
All right. Another interesting thing that in my whole entire life, I have never had interest deduction on automobile loans.
On automobile,
and I just think
automobiles?
that's automobile loans. Yeah, I just think that it's a very interesting deduction. However, so they have implemented that. There are some caveats to that, though. Your automobile has to be purchased after 2024. So
Right.
you have to, there's no mandates on whether it's a new or used vehicle. It just has to be purchased after 2024. So if you bought a new car this year, you can start tracking your automobile loan interest, because that will be an itemized deduction.
But there are some other limitations on that, depending on where your vehicle was assembled.
Oh, yes, it has to be assembled in the U.S.
Yeah, so you can't go find. Hey, we're not going to be political here. You have to be careful to know where your car was assembled in order to take that deduction. Yeah,
that is exactly right. And
it's
then
up to $10,000.
Up to $10,000, and then again, it will phase out at the end of 2028 tax year. And then another new thing, and I have this is my opinion and my take on this, so I'll put that in at the end, but there's a new thing called Trump accounts. And this is a creation of tax favor accounts for newborn children. And these accounts are seeded with $1,000 already for a newborn child, but it does give the ability for us, you can start a retirement account for your kids and you get a deduction for or a tax-free incentives for those. So I think that's kind of cool. And
Sure.
Here's my opinion on this. And I think we can
Opinion alert.
Opinion alert.
I
I think it's trying to have an alternative for Social Security, because we keep hearing Social Security is going to go away. It's going to go away.
Right.
It's going to be gone. So I'm wondering if this is something to help offset that possibility.
If you ever do any of this research with Dave Ramsey or any of these financial advisors, you can accumulate so much if you start from the beginning with just a little amount. And so I think you're right. This is just like, let's get something in place and start doing something so that there's something down the road if Social Security happens to not be there. So I agree.
Yep, that's right. So with that, I believe that is the highlights that I wanted to touch base on, unless you had something.
I had some, actually. I had some.
Oh, you have some extras? All right.
Yeah, so real quick. So like with the JCTA, the unreimbursed employee expenses went away. And this is a big deal for like sales people in the sales industry. If you're an employee, but you're spending money out of your pocket, you lost that deduction as an itemized deduction back in 2017. What's real interesting about this is it made it permanent. So you still can't take those deductions, but they do allow educators to take this unreimbursed employee expense, which is a big deal when you happen to be married to a teacher like myself.
That's right.
The other thing is this P's limitation is back. With itemized deductions. And so really the key here is that if you have a higher level of income, you run some risk of losing some of your itemized deductions, which Sara mentioned earlier is like your state taxes, your charitable contributions, your mortgage interest. If your income is too high, you could start to lose some of these deductions. They get phased out. That's been away since 2017, but it's now back on the books.
Yep.
Interesting
after
thing.
2025.
After 2025. Yes, ma'am. You're right.
Yep.
This is more or less just an interesting thing. When you have gambling losses, you can deduct and you itemize, you can take your gambling losses to the extent of your winnings as an itemized deductions. They've changed that. They have not gotten rid of that, but you can only now take that to 90% of your winnings. So you can't take all of your gambling losses anymore. They're bringing back that charitable deduction if you do not itemize. And so this deduction starts after 2025, but if you don't itemize, there's a $1,000 or $2,000 charitable deduction that you're now allowed. Let me see. I think that's about everything that I had on my list, Sara.
Oh, nice. Good deal.
For individuals. So
good deal.
Yeah. Lots of stuff going on.
Yes. Thank you for covering what I missed.
Well, I have a different source. All right. So you want to jump into the business now and see?
Yes. Let's do it.
So I think there's a couple things that are major. One of the major things is this qualified business income deduction, QBID, section 199A is left back to stay in the law. So what this does is if you have a pass-through entity like an S Corp or a partnership, you are provided a 20% deduction on that pass-through income. So if you had $100,000 of income, you'd get a $20,000 deduction subject to certain thresholds and issues.
Yep.
But that was a big deal for business owners, and it was going away, and it's now staying in the law. So that's a big deal. We talked about the pass-through elections for the state taxes. That was not addressed. So you still can use those elections with your entities to get a full state tax deduction. Let's go. There's some 1090, the form 1099 you file every year to report service income to individuals. that threshold used to be $600, and now that's jumping up to about $2,000. So maybe
That's
less
great.
1099s are issued.
Yes. Yeah.
Do you want to get into the research and development
Oh, yeah. I can
issue
get
real
into
quick?
that. Yes.
Yeah, you know
So,
more about that than I do. So
yeah, the R&D, research and experimental expenditures, prior to 2022, there was a direct expense election available. So any of your R&D expenses, you could receive both an expense deduction and get a credit, a tax credit calculated for those expenses. Well, after 2022 or during 2022 tax year, that expense election went away and you had to capitalize and amortize all of your R&D expenses. So instead of getting full deduction in year one, you had to amortize those expenses over 5 or 7 years, depending on, or 5 or 15 years, excuse me, depending on some parameters around those expenses. But now, with this new act, any expenses that were incurred in starting with the 2025 tax year reverts back to those same laws that were prior to 2022. So now we get full expense deduction and that eligibility for the R&D credit, tax credit. Another cool thing for this is for small businesses. Now, a small business is defined in the regs as a business that has average annual gross receipts of $31 million or less. And that average is over a 3-year period. So if you have an average of $31 million of gross receipts, then you can actually do a retroactive claim on those credits, or sorry, on those expenses back to 2022. So if you're eligible for a small business and you've been capitalizing and amortizing your R&D expenses, talk to your tax advisor, because you may be able to amend some returns and get back some money that you've lost. I mean, you haven't really truly lost it, but now you get to accelerate that expense deduction.
well, this is a key provision in the new tax law. And I think just to take a step back, if you have a business and you're doing any kind of experimental research, making processes better, these are the kind of things that we're talking about. If you're developing a product and making it better, this credit has taken some hits over the last year or two, and now this going back to this other way is a nice development. So if you're doing any of that in your business, you need to get with your tax provider and make sure that you're approaching this credit, because again, and we talk about this all the time, but a credit is a dollar for dollar reduction of your tax. It's not a percentage. So credits are always the bomb. And if you are doing any of this stuff, there's really a lot of opportunity to maybe do an amended return or keep some dollars in your pocket. So
absolutely.
So that was a big deal. Now, that was one big item. We talked about the pass-through, not the pass-through election, but the qualified business income deduction staying. That's the second big one. Third big one, bonus depreciation.
Yes.
We love bonus depreciation. So, just a little bit of history. Bonus depreciation came out after 9/11 as a way to really maximize the write-off of some fixed asset purchases in the year they're bought. There's been various revisions, 100%, 50%. Now it's phasing out 20% under the current law.
Right.
But that has all changed, and it's going back to 100% depreciation. Now, this is the funny thing.
Yeah,
it's
the date.
The date. Okay.
Yes.
So granted, it's 2025, but it's only for assets purchased after January 19th of 2025. So
and what day is January 19th?
Yeah, really? We're not getting political here.
No.
So if you, long and short, if you bought a fixed asset and you bought it after January 19th of 2025, you can take the full depreciation on it. Now, there are, this is one of those things that there really aren't very many limitations on as it relates to bonus. It's a 15-year asset or less. So most assets that are bought, you can take this deduction. But again, the offset to that, or the other side of that, is the Section 179, which was around for years and years and years before bonus, which gave you the opportunity to write off an asset subject to more limitations than bonus, but that's been expanded with the current law. So you can take up to $2.5 million of 179 expense, and as long as your equipment purchases are under 4 million. So those are some pretty big numbers, but we are back to the concept of being able to write off fixed assets in the year of purchase. So, and there's lots of different, what's the word I'm looking for? There's lots of different options there. And so it's important to look through all of them, but be aware, 100% bonus depreciation.
And it's permanent. Like we're not, because we've been back and forth on the 100%, and then it going down by 20% over a period of time. But now it is permanent. We don't ever have to worry about it going away. Right. Unless, they want to change the law again. Yeah. But right now it's permanent. So it's good.
And there's a lot of other provisions in this bill, this new law that they get very specific. But these are the big ones. The 199A, the qualified business income deduction stays, that 20% of your pass-through income, the bonus depreciation, the R&D credit expansion. Now, Sara, you can't just go and provide all these write-offs without having to take away something, because if you create the tax savings, there's other places that you have to take away. And so where that is really is in this energy section. There are a ton of energy provisions that were passed in previous administrations that are going away. So I could get into the details of exactly what they are, but if there's any type of credit that you can obtain, I'm going to say this is pretty widespread. If there's any kind of credit you're trying to take because of an energy efficiency tax provision, it's very possible that those provisions are going away after sometime in 2025. So if you're talking about, and I'm going to get a little code heady here, but if you're talking about 179D, 25C, the energy efficiency home improvement credit, even some of these credits on vehicles. Again, chances are if we're betting on an energy credit of some kind, it's very possible that goes away in 2025. So that's about everything, Sara. So let me just, as we get ready to kind of shut this down, again, we covered a lot of different things. Instead of doing rapid fire like we normally do, give me your top 2 or 3 things out of this that you find beneficial generally to taxpayers, and things you're kind of glad to see happen.
Yeah, absolutely. One of the biggest things I think is the bonus depreciation staying at 100%. I think that's super beneficial, especially if you're in the manufacturing space or even in any type of real estate space. And I'm thinking along the lines of cost segregations and being able to accelerate depreciations there. And then probably another thing is the increase on the cap on the SALT, the state and local tax deduction, now that's maxed, or the cap is now 40,000. I think that's going to be really beneficial to a lot of our taxpayers. And then, you make me pick 3. Just for me personally, I'm glad that the tax brackets are staying the same. That just makes it easy on people in our space,
for what
in
we're
our
used
profession.
to, right?
Yes.
Yeah.
And we don't have to worry about, by now I pretty much have those brackets almost memorized.
Almost memorized.
Yes. Yeah. And now that they're not moving, I probably will have them memorized soon.
Yeah.
What about you?
So I think the concept that a lot of the individual things stayed the same, as far as, like you said, the tax brackets, the standard deductions, and all those things. I think it's kind of nice that they're staying the same. They're staying in the law as opposed to going away. From a business perspective, the bonus depreciation is huge for our client base. The pass-through deduction is, the 199A is huge for that to stay, because one of the things we didn't talk about is that when that works, that effectively brings your high bracket from the 37% down to 30, which is really nice for a business owner. And so, the depreciation, the pass through, the cap on the state taxes going up, I think that's a big deal. I know, again, personally, I'm really glad that, well, actually, I'm upset that all my gambling winnings cannot be written off now. But I'm tracking my wife's expenses now. As a teacher, she has stuff coming out her pocketbook all the time.
I mean, wasn't it $250?
And see, that's what gets
Nothing.
me. It's like the tax savings on $250 deduction is like what, less than $5?
Yes.
And
why even put it on there?
It's the same thing when they did that before, when they did that, the charitable contribution for non-itemized filers. I mean, it was like $500, and it's like, okay, I thank you for that $10 tax savings, but they are increasing that to $2,000 or $3,000 or $1,000 or $2,000.
Yep, that's right.
When that goes into play. But the key to this, as we'll say all the time, is there's so much detail. More is coming out. Please rely and get acquainted with your provider, your tax provider here, because there are not only are things changing or staying the same and changing, but there's these different implementation dates. And so especially if you are an entrepreneurial business owner and you are used to these pass-through deductions, get with your provider, talk to them, see what's changing so that you can make good decisions, strategic decisions throughout the rest of the year. So
absolutely.
I think we've done what we meant to do. We kind of shotgun all that stuff. And again, get with your provider, talk with them, find out how this impacts you. If you have any questions or thoughts about any of this you want to share with us, you can email us at podcast@cckcpa.com. Let us know what you think. And if you have any questions, we're more than happy to respond and provide some insight. But I'm glad we made it through another Super Bowl Sunday here.
We did.
Sarah.
Yes.
It always makes our job interesting. And it's nice that they did it in the fall or the late summer as opposed to like December, right? So
right. Well, and you know what we should do next time another big thing like this comes? We need to take bets, because I'll say this, audience listening, Jeff and I were going back and forth all week. Like, is it going to happen? Is it not? And I'm like, I don't think it's going to happen. And Jeff's like, oh, I think it will. We should have bet on it.
We should have bet.
You would have won.
These things are always interesting. They're always controversial. But at the end of the day, we end up with law that impacts our bottom line and our pocketbooks. And it's like I've always said, the word says to pay to Caesar's what Caesar's, but it doesn't say how much. And that's where we come into play.
That's right.
So our job is to understand this to the greatest extent possible. And we're doing that. Our entire office is going through a process of learning this so that we can help our clients. And it's a big deal, and everybody needs to know about it. So we're glad we could bring this bonus material to our listeners. And again, there's more stuff that's going to be coming out over time, and we'll be talking about that. But thank you for joining us today. We hope it's been beneficial. Leave us a review or a comment and let us know what you think. And again, you can email us at podcast@cckcpa.com. Thanks for spending your time with us. And again, be sure to join us next time when these two CPAs get together to have a chat and you get to find out who's on the mic.
The information provided on this podcast is for general informational and educational purposes only and does not constitute accounting, tax, legal, or financial advice. While we strive to provide accurate and up-to-date information, laws and regulations change and individual circumstances vary. Always consult with a qualified CPA or professional advisor before making any financial or business decisions. The views expressed by the hosts and guests are their own and do not necessarily reflect the opinions of any organizations they are affiliated with. Listening to this podcast does not create a client-accountant relationship. By listening to this podcast, you acknowledge and agree to those terms. And that's a wrap for this episode of Two CPAs in the Mic. If you found today's episode helpful, please subscribe, share, and leave us a review. Have questions or ideas for a topic? Reach out. We'd love to hear from you. Email us at podcast@cckcpa.com.